Good morning. This is Dave Brinkman, a partner in our wealth management group, and we appreciate you joining us this morning. As you can see on the slide there, and hopefully you've seen some of our communications this summer around the book, The Psychology of Money, written by Morgan Housel. We're going to get into a couple of the concepts in the book that really resonated with us, but big picture, let's talk about why did we choose to kind of share this with clients and friends and prospects. Really, so much of what resonates with us as advisors that make our livelihood as advisors is really it's the behavioral aspect of money, right? It's not necessarily what you know, as much more around, well, how do you behave? And behavior is really hard to teach, even to really smart individuals. I think another example that they use kind of at the interlude of the book is, look, in the real world, people don't make financial decisions based on a spreadsheet. They make them sitting at a dinner table in meeting rooms, personal history, their perspective of the world. That's really kind of a much more complicated answer than just looking at a spreadsheet and saying, well, here's the investment decision or here's what you should do. And hopefully you've enjoyed the book. Obviously, it's a series of 19 short stories really explaining maybe the strange ways that people think about money and what can we learn from that. One of the quotes that I've always come back to, and I think I've shared this in maybe a couple of articles that I've written, but the best way to measure your investing success is not whether you're beating the markets, but by whether you put in a financial plan and a behavioral discipline that are likely to get you where you want to go. I think really that is what resonated with us. And one of the examples you see in the book, and my colleague James is going to talk about it a little bit further, is the janitor, Ronald Reed, right, in the introductory section. Never made more than a nominal amount of money over his lifetime, but yet he was able to accumulate, I think it was an $8 to $10 million portfolio by really kind of controlling his behavioral and how he handled his money. So big picture, let me set the agenda for the audience here, and we'll plan to go for about an hour. We'd love to have the interaction. As you can see with the software, there's a Q&A section. Should you like to send us a question during the webinar, we'll do our best to either answer it or obviously we'll follow up with you and can have a conversation with you outside of this webinar. So we're going to touch on three main kind of sections today. My colleagues Derek and Alyssa are going to come on and talk about keeping up with the Joneses, why the U.S. consumer thinks the way they do. That was really a postscript to the book. We'll also hear from Nancy Skeens and Jason Staley around luck and risk and confounding compounding. And finally, we'll bring on James Moyer and Matt Biggs around, simply, look, save money, right? There's various reasons why to do it. But and then we'll kind of look to conclude. And like I said, we'll go for about an hour this morning. So Derek, Alyssa, I will turn it over to you guys.
Thanks, Dave. Hi, everybody. It's good to see a lot of familiar names on here. The first thing, as Dave mentioned, we wanted to bring up the postscript, even though it was at the end of the book. But it really highlights how financial thinking and behavior have changed since World War II. And if you could ask anybody that was an adult at that point to predict how it would look today, I think it would definitely be unpredictable and unrecognizable to them. So Derek and I would like to start first by just walking through the timeline that he put out in the book, beginning, August 1945, the war ends, about 16 million people who served have come back home. What's next for them? You have a lot of newly married people. They're ready to start a life and a family, but they were facing a severe housing shortage and definitely a lack of jobs. The Great Depression was still a strong memory in people's minds, and there were talks of another one to come. So what was the U.S. response? Low interest rates. So cheap borrowing opportunities, coupled with the shortages and everything, caused inflation to really soar. The GI Bill was introduced, and it helped soldiers returning home purchase homes with no money down and some really good interest rates. But along with that came the introduction of consumer credit. And at that point, unlike now, the interest of that was tax deductible, which really encouraged people to borrow to be able to buy things. So segue into the 1950s, you have the credit boom. You have a productivity boom as people realize, hey, we can create jobs. There's a need for stuff, right? And that demand for stuff created jobs. You add in the consumer credit, and spending really exploded in that time frame. It increased to 40% over that of just from 1944. But something interesting then is the equality of money really increased. So the poor became less poor, the income gap narrowed, more women and minorities were employed than ever before, and everyone had a lot of the same things. They were all driving a car, they were all watching a TV in their living room. And so people really started to measure success against their peers because they all were living pretty equally. It was easy to do. Even a lawyer living next door to a mechanic, they all pretty much had the same things. So debt was rising, but so was income. So people kind of ignored that debt was becoming a bigger problem, and younger people really stopped fearing debt the way that their parents did. We enter the 1970s when a recession began. Obviously, inflation surging, unemployment surging, short-term interest rates are going up. But people were still rooted in that culture of post-war equality of lifestyle and consumption. But what was different, or starting to become different in this period, is the income gap began to widen. So I'm going to hand it over to Derek to transition into the 80s and 90s.
Yes, thanks, Alyssa. As we get into the 80s and 90s, we have an economic boom that was fueled by lower inflation and lower interest rates. We saw home ownership increase significantly during this time, and unemployment was decreasing. All these things added up to our GDP, or economic growth, soaring. So, really great time economically. And what this environment really did was, usher in a new dynamic for the consumer. As Alyssa was mentioning, we were starting to see income inequality growing, and it started to really grow rapidly. But what was interesting is, as this income inequality was occurring, people held on to the belief that they should have the same lifestyle as everyone else. And the way they were able to accomplish this is they used debt to finance that higher kind of lifestyle. Now, this is, the time period where that keeping up with the Joneses mentality really took off. So this was, changing lifestyle, even though your income wasn't changing dramatically. We look at today, most people have more bathrooms in their homes than we have occupants. Car loans have more than doubled from the previous time periods. And student loans are, a huge problem for a lot of people. Debt to income ratios increased to 130% by 2007. And this issue was even more dramatic for those people located in the lower income groups.
In 2007, Derek, that was the year that many people really became aware and unable to service the debt that they took on. I know you were advising clients in that 2007 to 2009 timeframe. Can you tell us a little bit more, like, what was the result of this keeping up with the Joneses line of thinking in that timeframe?
Yeah, so, that rubber band that was consumer spending got stretched a bit too far. And during this time period, it snapped back pretty dramatically. Consumer debt was shed very quickly. I mean, at that time, people didn't own one home, they owned multiple homes because it was easy to do so. We saw interest rates plunging dramatically to help stimulate the economy, which also helped, people manage those debt loads a little bit better. Household debt payments, when you compare them to income, came down dramatically as well. The government reacted with a lot of quantitative easing, boosted asset prices, stock prices. And then you saw, the tax cuts and bailouts, they were helpful. Now, it was, helpful, to a smaller portion of the overall population. So, at that time, what we saw was the economy was working for some, but not for all. And that, caused some dislocation that was a bit painful.
Absolutely. Well, thank you for sharing that, Derek. We're going to shift to some other topics in the book. When we come back at the end, Derek and I are going to talk a little bit more about how modern days with social media have really added to this issue and how we help clients combat biases. So I'll turn it back over to Dave.
Thanks, guys. So and again, we're gonna go a little bit deeper on a few of the chapters, right? And obviously in an hour webinar, we can't touch on everything, but these were the couple that we wanted to go a little bit deeper on. So I'm gonna bring on Nancy and Jason, and Nancy's gonna talk about the chapter where luck and risk. And what I love so much about Morgan's writing is he really makes it, he's a storyteller to kind of ultimately prove the point he's trying to tell you. So if you recall from that chapter, Bill,
I think David froze. So I hope that you can all hear me. I'm going to go ahead and jump into the chapter on luck and risk. So the team let me pick the chapter that I wanted to talk about today. So I guess age really does have its privileges. What do you think? Do you really think we all live on a continuously spinning roulette wheel? I admit that was the first image that came to my mind when I read this sentence in Morgan's book. You are one person in a game with 7 billion people and infinite moving parts. The accidental impact of actions outside of your control can be more consequential than the ones you consciously take. Then I decided no, not a roulette wheel exactly. We all know that the house has the odds in their favor when it comes to a roulette wheel. But we do live on a continuously spinning planet where the forces of luck and risk are real. While we might not have absolute control over these forces, and sometimes it feels like no control, individual decisions and individual efforts do make a difference. As for luck, when it intervenes in our lives, David was going to mention Bill Gates and his high school computer. That's in chapter 2. When I think about that, my mom's words come to mind. My mom always said, if you're not prepared when luck opens its doors, you probably won't even know that it tried to visit. Fortunately for us, Bill Gates saw the door open. He ran headlong through it, and with effort, teamwork, and time, he created Microsoft. And risk, we need to look no further than our recent experiences with COVID. But for our own actions and the actions of millions of others, we are still moving forward with our lives. So as investors, why should we care about luck and risk? How many of you would consider the great financial crisis of 2008 and 9 as a lucky financial opportunity? I'm guessing that your answers are probably mixed. Sometimes investors just happen to be on the right side of a market correction. For example, what if you sold your business and you were sitting on $5 million of cash on November 1st, 2008? Remember, that was after the first crash, the initial crash in October. In real time, would you see this as an investment opportunity? Only if you were ready to plug your nose and put your cash to work in the middle of an unfolding crisis. Did it matter if you picked the bottom of the market? We all know that stocks go on a 5 or 10% sale every now and then. What mattered in this event is that you realized that the entire world of stocks was on the clearance rack at the same time. I met with a client just this past week, and we were reviewing her portfolio to pick an appreciated security for her to give to charity. And I said, hey, let's use this one. It's up 500%. And she looked at me and said, how did that happen? And I said, looks like we got lucky. We bought that position on December 1st, 2008. If you don't see the luck in that situation, let's look for the risk and make it real. I work with a wonderful woman who retired in June of 2008. Her portfolio was not in cash. It was fully invested in a 60% equity, 40% bond allocation when the crash occurred. She certainly was not in the frame of mind to add to her equities. But she did not let the bad luck of the market meltdown months before her retirement, months after her retirement, derail her long-term plans. She held her ground and her asset allocation through the worst luck a retiree can imagine. And today her portfolio has fully recovered and has grown into an even larger nest egg. What about the risk that investors impose on top of just the everyday market risk to make a little bit of extra money or to goose their returns? One example of this would be holding a highly concentrated position in the portfolio. For example, what if you just owned a basket of bank stocks going into the 2008 crisis? You might have done that. Bank stocks were actually doing tremendously well going into 2008. But what happened? Many banks ultimately went belly up, or they were eventually purchased for pennies on the dollar. Do any of you remember National City Bank? Adding excessive risk to a portfolio can be a very quick way to wipe out all of your wealth.
Thanks, man.
It can be a way to make unexpected gains, but it doesn't always work in one's favor. And that leads me to one last point regarding Chapter 2 and risk and luck. Morgan pointed out that many of us, well, all of us, I guess, hear stories about how great investors are so successful. But we are seldom enlightened as to what role luck plays in their success. And sometimes their luck is actually defined as skill. Don't be seduced by other people's investment successes. We don't have to look far to see the negative impact of chasing others' returns or success. Let's just look at GameStop. I think all of you probably heard about the buzz around GameStop that occurred mid-year just this year. GameStop was touted across the internet by many traders, and a lot of people probably made some money on GameStop. But let's think about those who bought it at the top, in the middle of that touting high of how this stock is so great. It was selling at $483 a share in mid-June. Today, it is trading at $196 a share. That's a 60% loss from its top. And those poor guys and gals that jumped in mid-June are probably not thinking that they were very smart, and certainly they were not very lucky. As we continue our journey today, we're going to explore ways that you can harness the power of luck when it opens its doors in investment opportunities. But more importantly, we want to share strategies that can help mitigate the consequences of risk when risk throws its inevitable curveball. I am going to introduce my partner now and our Chief Investment Officer, Jason Staley. And Jason's going to explore Morgan's chapter on Confounding Compounding and how this can help us manage the risk. Take it away, Jason.
Thank you, Nancy. And I think when we talk about compound interest and what Morgan titles kind of confounding compounding, it's such a nice segue to talk about luck and risk because they play such an integral part in a portfolio's compounding return or the opportunity cost that investors sometimes impose on themselves because they're not able to access the entire opportunity set of compound interest. And so I think when Morgan talked about this part in the book, he mentioned, Warren Buffett. And at the time of publication, Warren Buffett's net worth was $84.5 billion. From 65 on, of the $84.5 billion of his net worth, $81.5 billion came after he was 65. That's the power of compounding. Now, yes, there's no doubt that Warren Buffett is one of the most skilled investors of all time. But he's been doing it a long time as well. And that time in the market, allowing his financial holdings to compound, that time was his secret power. And if you're not going to listen to Warren Buffett, Albert Einstein called compound interest the eighth wonder of the world. He remarked that he who understands it earns it. He who doesn't pays it. And I think it's a remarkably simple and elegant way of explaining compound interest. And I think when we sit down as advisors and we're talking about compound interest, really it's this idea of, going back to the risk side of it. There's two components to it. There's financial risk, which is your ability, how many assets do you have to put in the market? And then kind of the emotional risk set, which is how much can you stomach? And so when we, how much volatility, as Nancy put it, can you stomach without saying, I need to reduce my risk in the market. I just can't take my portfolio going down anymore. And so when we're putting together portfolios for clients, a lot of times you'll hear a lot of talk of, is the right stock to bond mix 60-40, 60% stocks, 40% bonds, or is it 40% stocks and 60% bonds? But year over year, the variability between those two portfolios, 1% to 2% on an annualized basis. What really matters, and Morgan touches on this in the book, what really matters is you as an individual investor, putting blinders on and just focusing on you as the investor. What is the appropriate portfolio for you so that you can earn all the available return given your ability to take on risk financially and your ability to emotionally accept the movements of the market. And that is the key element, because yes, you will earn more over time if you're an 80% stock and 20% bond investor, but that's really hard in March of 2020 when COVID takes the S&P 500 from an all-time high to down 30% in 21 days. It's really hard to be an 80% stock investor and a 20% bond investor. But if you were a 60-40 investor, you didn't love looking at your portfolio during March of 2020, but you also felt comfortable enough in your plan and what you held that you saw it through, your portfolio did very well in 2020. Now, it was a rocky ride, but you were able to earn the maximum return available to you because you stayed invested, because you allowed your portfolio to compound for you. And we just wrote on this, I wrote on this topic a few months ago. And let's take $100,000 in the S&P 500, which in almost everybody's portfolio, they own this as probably their largest U.S. stock allocation, right? It's the 500 largest companies in the world, or excuse me, 500 largest companies in the U.S. Many of them are also the largest companies in the world. These are the Facebooks, the Apples, the Amazons, Microsofts. Those are the largest J.P. Morgan. So if you were to take $100,000 in 1970, and as of 6/30, so as of June 30 of this year, you take $100,000 to buy the S&P 500, it turns into a little over $500,000. That's a great return. That's phenomenal. You made $400,000, a little over 50 years. It works out. That's it. That's a phenomenal return. If you take that same $100,000 invested in that same S&P 500, but you reinvested the dividends, that $100,000 as of June 30th of this year turns into a little bit over $2.2 million. The difference between the two, about $1.7 million. But that $1.7 million is not done. It doesn't happen overnight. It doesn't happen in year 5. It doesn't happen in year 10. And even really in year 20. When you look at that chart, those lines are really tight together, price return and reinvesting the dividends. But as we go on, as you see that power of compounding, just that extra 2 to 3% of dividend yield reinvested back into that market, that is really where you get to access the full opportunity set of the eighth wonder of the world. And if nothing else, it is really not bad to hang your hat on, in the company of Warren Buffett or Albert Einstein. So when we think back about the power of compounding, it's really a conversation between client, investor, advisor, and making sure that we give you the entire opportunity set to access that. So whether you're a 60-40 investor or a 40-60 investor, just getting the entire amount of return in a given year and then compounding that over a lifetime is going to help you reach your goals and objectives in a fashion that allows you to live the life that you want to live. So that is the power of compounding, or confounding compounding, as Morgan would like to say. And with that, I'm going to pass it over to my colleagues, James Moyer and Matt Biggs, to talk a little bit about savings. I think David's going to introduce them, but thank you for taking the time to be with us today.
Looks like maybe we lost David again. Matt and James, do you want to pick up where Jason left off?
Yeah, listen, no problem at all. We'll get Dave to come back here shortly, I'm sure. When it comes to the savings chapter, I think it's pretty easy to think we can just save more money, and that's the end-all be-all for our portfolio. But in fact, it's really hard for some people to really grasp that concept. I think the best point that I picked out of this chapter was the savings rate means more than the investment return. I just think of this brief little question here. What's easier, spending kind of 80 hours per week, as Morgan pointed out, which some investment managers do, trying to squeak out an extra 0.1% on investment returns, or just cutting your budget by maybe $100 more a month and saving that much more into your portfolio? I thought that was a very great example of what savings can actually do. And I refer back to the beginning of the book when Morgan talks about Ronald Reed. He was a janitor. He swept floors for, I think, over 14 years of his life. He ended up passing away with an over $8 million portfolio. And I think he said in 2014, when Ronald Reed passed away, he was only one of 4,000 people in the U.S. who died with more than $8 million in his portfolio. Ronald Reed didn't make outrageous investment returns. He was invested in simple index funds for the majority, if not all, of his life. But what he had that most people don't have is an amazing savings rate. And I think when you think about savings rate, how do you derive that rate? Well, it all starts with the conversation, which we have with almost all of our clients, and a lot of people that don't even end up becoming our clients, is starting with a budget, sitting down, doing that tedious task of coming up with a budget, figuring out your income, all your expenses, and figuring out what you can live with or without. I'm going to pass it over to my colleague, Matt Biggs, and he's going to talk to you about a great example personally that he's experienced.
Yeah, thanks, James. And before I get into my personal example, I'm going to get on my high horse a little bit here about budgeting. So, budgeting is probably the least fun, and the least sexy topic that we could talk about when it comes to your overall financial plan and your overall investment strategy. But in my opinion, it's probably the most important topic, right? The whole, the title of this chapter is Save Money. It's hard to save money if you don't have a full grasp on your budget. So, like James said, I'm going to use a personal example here. And my personal example, if for those of you that know me, you know that I've got a young son. And I'd rather use this example than maybe a client's and throw a client under the bus. I'd rather, take the blame on myself. But I've got a young son, and my wife and I, we were like, you know what? Coming up to her due date, we said, we really need to get a grasp on our budget. What are we spending and where are we spending it? So for us, we were spending a lot at the grocery store, and I couldn't figure out why. So I found out we were spending roughly $100 to $150 a month on Gatorade, of all things, which is outrageous, right? Like I remember thinking, how in the world am I spending, $100 to $150 a month on Gatorade, of all things? I drink a few a day. My wife at the time was in her third trimester. I think she was putting a few back a day. So I immediately was like, look, we're done buying Gatorade. And that's an extremely small example from a monetary standpoint, right? $100 to $150, not a huge amount of money. But I think if we tie it back maybe to Jason's topic on confounding compounding, you invest that in an S&P 500 fund and let it compound. Now, it's not going to grow to $84.5 billion anytime soon, but it can grow and grow. And I have no idea what I'm going to need that money for. But that goes back to the next topic of you don't need a reason to save, as Morgan says in the book. You should just save. So in this Gatorade example, I have no reason to save that money. We were already hitting our savings goals, but I have a feeling that at some point, someday, I'm going to need that money. Maybe the example I use for that is if you follow the real estate market at all, you know that it's very competitive today, right? So, 5-10 years from now, when I go to put an offer on a house, having that money set aside, well, that could be my appraisal gap that a lot of people are having to offer, saying, hey, I'll go $5,000, $10,000 above the appraisal. So it's things like that, the cutting the Gatorade out of the budget that gives you the flexibility to do those things in the future and put in those offers. I know that's a small example from a monetary standpoint, but I think it really flows through. So, James, I will come back to you about taking control of your time before I finish it off.
Thanks, Matt. Another concept that Morgan talks about is by saving whatever you can save, just saving to save, it really gives you a sense of taking control of your time. You don't have, let's just throw an example out there. If you're in between jobs or you're not unhappy at your job, but you have a very large savings account that you've built up and you've just saved that for whatever, but you've built up a very healthy savings account, you can take your time finding the job of your dreams, taking time interviewing. You could spend up to a year and you have control of what you want to do for your life just because, you've made that simple contribution to yourself by saving that excess Gatorade money that you gave up. I thought a great quote that Morgan put in the book was, saving is a hedge against life's inevitable ability to surprise the hell out of you at the worst possible moment. And that really just goes back to saving whatever you can save just to buffer that blow if the market corrects like it did in March of 2020 or back in the great financial crisis. You have control of really your destiny at that point if you have saved enough and you live comfortably. The last point I'll add to the Saving Money book really just goes back to starting early. I have a young daughter. I think some of you know this in the audience. She's 4 years old. And it's a principle that you can instill in children at a very early age just by simply getting a piggy bank and having them start to save. And it's something we can be taught early on, but for some reason, once we get older, sometimes we tend to forget some of those simple life practices. So with that being said, I'll turn it back over to Matt to finish up this chapter and get back on to the next topic in our book.
Yeah, great point, James. So I think the last thing I want to talk about, if you're reading chapter 10, there's a section called "The Value of Wealth is Relative to What You Need," and it really it's getting back to that whole keeping up with the Joneses theory, and Alyssa and Derek did a great job hitting on that. So I don't think I need to talk further about it, but I do want to give an example. And the one I was going to use was actually from the book that Morgan uses, but something Nancy said earlier about a client example really sparked something in my mind of a great example that I have. So we have a client that retired 12/31 of 2019. So for those of you that know what happened, basically the first quarter of 2020, COVID, and markets crashed. So I remember having, those conversations with this specific client. Literally worst case scenario, right? You retire 3 months later, we hit a global pandemic, markets bottom out, towards the end of March, and he's seen his portfolio really take a hit. But it comes back to, keeping up with the Joneses, and the value of wealth is relative to what you need. Let's say his portfolio is, and I'm just going to use kind of ballpark random numbers here just to make it easy, $5 million, okay? And he's only spending $5,000 to $10,000 a month. Well, we don't really have much concern because he's also collecting Social Security, he and his wife, and you're not really using the portfolio for much income. So at that point, he's done such a good job, keeping all the excess expenses out, that the value of his wealth is relative to what he needs. And we could see an even bigger crash, and there's still not a lot of concern because he's spending so little. Now, on the flip side, if this client had been spending $20,000 a month, then yes, we've got some serious concerns. But he's done a great job keeping his expenses to a minimum. So that's one example of, the value of wealth is relative to what you need. And then the last thing I want to talk about, and it'd be real quick, is Morgan hints on this thing he calls lifestyle bloat. And it's really just a concept of, like James was mentioning, people spend hours and hours chasing larger returns, right? And getting that extra 1% to 2% returns. When you could just look at your expenses, look internally, and what are the 1% to 2% to 3%, of lifestyle bloat, or things that you're spending money on that you really don't need, that you can cut out, and there's your 1%, 2%, 3%. So, the lifestyle bloat in my scenario was Gatorade, right? So cut out Gatorade, and that's that 1% to 2% of lifestyle bloat that goes back into my savings. So I think, to sum it all up, look, there are a few things you can control. How much you spend and what are you spending it on, and, your income to a certain extent. You can control what's coming through the door. What we really, hint on is keeping your expenses in check can help increase your savings, and it's really going to set you up for continued savings. So at this point, I am maybe going to transition back to Dave. Dave, are you there? I'm hearing a no. Melissa?
Okay, I'll take it because I have one more thing to bring up that I mentioned during Derek and I's talk about media. Obviously, media has exploded ever since 1944. It'd be one of those things that if you were to ask someone that lived as an adult then what media would look like, they certainly would never be able to predict what it looks like today, especially social media. And it keeps us keenly aware of what other people have and what other people do. So it really is just a continued driving force for the keeping up with the Joneses mentality. So what we need to remember, though, is what we see on Facebook probably isn't the full picture, right? Someone's $25,000 vacation might have completely gone on a credit card that they can't afford to pay off. So with that in mind, I want to bring Derek back in. Our goal really when we work with clients is to eliminate or at least really minimize the psychological biases that we learn throughout our lifetime about our finances. So Derek, can you talk about some of the ways that we do that with our clients?
Sure, Alyssa. Social media is incredibly effective at encouraging that keeping up with the Joneses mentality. What we've found is kind of a couple of simple ways of working with our clients that I think directly addresses that. And that's two things. One is, the budget, as we've talked about before. And, the second is a financial plan. The budget tells us where someone is today. Are they spending more than they're making? Because that's not a sustainable situation. But when you take that information and then put it into a detailed financial plan that shows people, from now until retirement and beyond, where they're going to be and what their lifestyle will be able to be in the future, it's a fairly sobering conversation for a lot of people. So, that's something that has, I've seen it have a dramatic impact on people and their behavior because, the numbers don't lie. So, You know, when you say to someone, okay, you know, you can keep doing what you're doing, you're going to run out of money. You know, if you want to retire at age 62, you're going to run out of money at age 70. And, you know, they're tough discussions to have, but the nice part is then people have some time to fix those. So, you know, any of us can get caught up in what you see, you know, day to day on the social media. But, you know, when you go down and you run numbers and you know, really show people what the implications are of today's decisions, it has a powerful impact.
Yeah, I've absolutely seen that too, Derek. It's financial planning can be a very powerful tool. So, Dave, do we have you on here? We're gonna, if not, I'll start jumping into the Q&A. Still no Dave. He's having a rough day with technology. So as a reminder, this software allows us to take questions that our advisors are all here to answer from you. We have a couple questions that have come in, but you know, as we keep talking, feel free to type in your question and we'll try to get to it in this time frame. We have about 15 minutes left. If not, one of our advisors will absolutely reach out to you to answer your question. So first question that came through is thoughts on paying off a home early. So Nancy, why don't you speak to that one?
Great. I'd be happy to speak to that. I've answered this question numerous times. And remember, the situation is always going to be slightly different for any person in this scenario. But there are a couple reasons why people like to use like to use debt when they purchase a home, even if they can pay the entire cost of the home off. The first reason is there is a deduction, if you're able to use it, an itemized deduction on your tax return. That itemized deduction basically helps lower the cost of the debt even further for you. The second reason is when interest rates are extremely low and there's a possibility that they can go up in the future. And as they go up, your potential to earn more on assets that are invested, even if they're invested in bonds, may mean that you're making money off of the bank. So if you could do a 30-year mortgage today for 3%, and 3 or 4 years from now, you're able to invest in a money market account at 5%. Should we ever see that again? I don't know. But should you be able to do that, you know, you've got a 2% play. But let's take that's what it's worth. And then I'll put up the other side of this. Why pay a mortgage off if you can? I learned a lesson in 2008, and I think that lesson definitely was learned because of the responses that many of my clients had in that particular scenario. So you go into 2008 and 9, the crisis is real, it is big. And one of the things that you have to write a check for every month is this mortgage. And sometimes these mortgage payments were pretty significant. If you're retired and you're in a situation where your assets are dropping in value, even if you can deal with that situation and you have the money to make your mortgage payment, it becomes very uncomfortable to start dipping into your assets in a down market to cover that mortgage cost. And sometimes that difficulty is really it's psychology. It's really in your mind. So I have come to believe that when you enter retirement and you no longer have a paycheck coming through the door, or your business, you've sold your business and you're retired from your business, so cash flow coming in is probably limited perhaps to Social Security and your investments, go ahead and pay that mortgage off. When you have a point in time where you see a crisis unfolding, whether it's 2008-9, whether it's the COVID crisis that we face now, but particularly in March in the markets, you will sleep much better if you know you don't have to withdraw those funds out of your portfolio to pay that mortgage down. So if you're inclined to pay it off and it makes you feel better, go ahead and pay it off. It is another form of savings in its own right because you basically have added to the equity that you own in your home.
Thanks, Nancy. And while we have you on here, did you want to add anything to the budget conversation? I know this is something that you've worked with a lot.
Everybody hates budgets. It's budgets are not natural, and that's probably because, as James pointed out, we learn a lot of lessons growing up, but maybe a lot of our parents did not budget, and so we didn't learn that lesson. But what I wanted to add is James and Matt talked a lot about savings, and I know that many of our clients are retired, so you're not in a savings mode anymore. Many of you are in a mode where you are living off your portfolios. But budgeting is still important there. And the reason it's still important is because, similar to the question on should I pay my mortgage off, when you get into a situation where the markets are stressed, if you know where you can cut out expenses or you know how much you're spending, you are going to be able to sleep much better. You don't have to budget down to the penny, the nickel, and maybe not even the dollar, but it still provides you a level of comfort when we reach situations that are truly out of our control. So I just wanted to add that for our retired clients. Yes, I still think that we should have like some budgets out there.
And let's see, does this work? Are we good? Yeah, I'm good.
Yes, you're good, Dave.
Yes,
All right,
Dave.
so here, look, I've had my own little luck and risk during this presentation. Risk being live presentation, luck being technology behind me, the technology group. So I wanted to, Jason Staley, I'm going to direct a audience question at you, and it's really getting at the seduction of pessimism, which I find fascinating, right? So I'm looking at the overview of the chapter. Basically, Morgan says optimism sounds like a sales pitch, whereas pessimism sounds like somebody's trying to help you. So let's go even a little bit further, right? So last March, we had COVID. Now there's concerns around China and what exactly does a communist capitalism look like? Concerns around the government shutdown at the end of this month, right? There's a litany of things. And my personal view is you're always having to climb a wall of short-term worry, but maybe building off of that, give the audience a little bit more on the seduction of pessimism.
Well, I think that it's human nature if you kind of go to even the psychology of money, kind of the pain of losses is psychologically speaking more powerful than the feeling of joy when you have a gain. And I think kind of that pessimism kind of dovetails into that, it kind of dovetails into that, which is to say that it's just a lot easier to be negative. And I think that because we tend to overweight things, we have biases that overweight the negative versus the positive. I think that it's easy to fall prey to that in the moment. And I think the best way to really combat that is to really just take a step back and take a look at a long-term chart of, whether it be the S&P 500 or even your portfolio. Just take a look out, and it's, yes, there are bumps along the way, and sometimes they can be gut-wrenching. Like March was very scary, right? Your portfolios were dropping. It was potentially a very deadly but kind of unknown lethality of COVID-19. Not exactly the time you're thinking you need to pull, to press the pedal on the gas accelerator and start buying equities. But it ended up being a wonderful time to buy. And again, it's just easy to fall prey to overweighting all of the negative things. I know our colleague Derek Eichelberger is prone to say, it's like investing is the only thing in life that we as Americans do not buy on sale. The market goes on sale and we never run to buy it. That something goes on sale at, whether it's the clothing store, the furniture store, or the grocery store, we buy more of it. And again, I think that goes to that pessimism. And I think having a very productive relationship, that's a two-way street as advisors and as clients, that's a great way to get over kind of that pessimism that you have, is to really take a step back, maybe consult someone that's kind of outside that maybe will positively reinforce or give you some reasons to be excited. But there's no doubt that pessimism, and I deal with it as well, where you tend to overweight the negative. Like yesterday, market dropped 2%. I mean, the market's still up 18% in the U.S. market. So it's up 18%. But you can, a lot of times as an investor, you can overweight that 2% relative than focusing on hey, we're up 18% in 2021. So I think that the pessimism sometimes, or the overcoming that pessimism is oftentimes requires us just to take a step back and realize that not all optimism is a sales pitch.
Well stated. So we're going to jump to another question. And obviously, guys, we welcome your feedback. We got about 10 more minutes here. We'll go to the bottom of the hour. So I'm going to bring back on Matt Biggs. There's been a lot of questions picking up on Nancy's commentary around budgeting. But Matt, maybe give the audience a little bit more. Are there tools? Is there software kind of help us from a budgeting aspect? And let's avoid the massive spreadsheet, right? Because there's always a spreadsheet when we start talking budgeting.
Well, I was actually going to say, Dave, for those of the nerds out there like me, if you really want to dive in and you want a spreadsheet, feel free to email me. I'm happy to send you something. But where I personally found the most value was, I mentioned earlier, we got into a really deep, detailed budget for myself towards the end of 2020. And I use mint.com. So, you can sign up for Mint. It's free. It'll track everything as far as, spending categories, et cetera. Now, I want to, headline, it's not perfect, right? So you're not going to find any software or any budgeting tool that's going to be absolutely perfect. There will certainly be months where something will pop up and it'll say, hey, you spent $1,000 extra on auto care. And I was like, well, that's certainly not true. But for 99% of the transactions and the big high level details, I'd highly recommend getting yourself set up on mint.com. You can link everything. You link your credit cards, your banking account, checking and savings. And it's a great way not just to get a full grasp on your budget and where your money is going, but also to get an idea of, overall net worth and those type of things.
Thank you for that, Matt. Alyssa, one of the things you and I have talked about throughout the summer as we've been reading the book, and again, it's really getting at the psychological aspects that I found so fascinating with this book, with the nature versus nurture, right? So nature, you are inherently born in a certain way and you're predisposed to certain thinking, just kind of being the human being that you are, versus the nurture side. Maybe you were brought up to think about money in a certain way, or you observed your grandparents or your parents, and I thought you did a wonderful job kind of walking through the decades, if you will, and how people think of debt and things like that. So maybe for the audience, let's build off of that a little bit.
Yeah, absolutely. And it's absolutely fascinating. I'm happy to talk more with anybody that really wants to dive deep into the psychology of it, but how trauma can actually imprint on a baby's brain when it's born in their DNA. And so different traumas that people experience, parents, grandparents, can be actually passed along in a nature type way. So let's say you have a child that's already born anxious and they're born into a family that, doesn't make much money. They struggle. They grow up not having, the things that they need or the things that they see other kids having, seeing their parents stressed over money. And then that child becomes extremely successful as an adult. Let's say you're making $500,000 a year, but you're still living like a pauper because in your mind, you get so anxious over not having enough because that's how you grew up. So I think it really is that nature and nurture dichotomy, right? Is, do your parents and the people that are around you solidify those insecurities and psychological things, right? Or do they help to change them? And I think James had brought up a great thing with kids too, is, starting to introduce them to the piggy bank system and, earning money. For our daughter, we have 3 piggy banks, and since she's older now, we've transitioned her into an envelope system, but have give, save, spend, and then now she has some envelopes, right, where she can save towards specific goals. And then she has a chart with ways to earn money. So I think it's really important if we're going to change the trajectory of financial thinking to start with with kids that are young and really look at our own biases and make sure we're not confirming them and passing them along too in our children and grandchildren.
Well, Alyssa, if I can pick up on that, right? So a lot of times we talk, and let's just say you go through primary education, high school and college. A lot of times, unless people seek it out, there is no personal finance class that is kind of a mandatory curriculum, right? And then, you know, and I think Morgan highlights this throughout, we are so colored by our own experiences with money and, you know, to the positive or to the negative. I just find it, I keep saying this because this book has resonated with me so much, but just being aware, right? And having an awareness of your money. Where does it go every month? Again, it's really just getting people to maybe become more aware of their spending habits and maybe their own biases. Is that a fair way to kind of think of this? Absolutely. I think self-awareness is key to success in, you know, overcoming anything in life, and especially money. Yeah. So, yeah. And I think this book is a great start. There's also a lot of, you know, money personality type quizzes that are out there. I know that's been a fun experience for my husband and I to take some of those quizzes and, you know, see where we both lie on our thinking, right, with spending and saving. And I think it's a great conversation to be having, you know, to work on yourself to overcome those biases and just realize what they are. It's powerful. So we've got about a couple minutes left, and I see a final question that just popped up. So I'll pose it, and obviously I can address it, but if there are other advisors that want to chime in here. So any stories of your clients taking advantage of money that buys you time? Nancy, I'll give them a quick response on my side, and then I'll turn it over to you. But yes, absolutely. We're in the midst of the great resignation, right? That people are evaluating their life. Maybe they weren't happy. I'll piggyback off of Matt and James's chapter. This is why you save money, right? It's the ability to kind of control your time. Maybe you're just not unhappy with where you're at and you want to take a little bit of a sabbatical and reevaluate. But yes, absolutely. The ability to kind of have full control over your income stream can buy you a lot of happiness, time, and really just give you more control. So maybe, Nancy, build off of that.
I'll build off of that. Thanks, Dave. That's a great question. And first, I want to say that, you know, the best part about the work that I do, and I think my peers on this presenting board would echo it, is being able to work with individuals and watch them succeed and help them succeed. So I'm going to tell you another client story. I love my clients, and I love being part of their successes. So this was an individual I met in the late 90s. And money does buy, you know, money can buy a lot of things that are just there and gone, or they're piled up at the garbage can, you know, in the garbage can on your curb on a weekly basis. But if you look out into your future and say, money gives you freedom, that's the one thing that, you know, it really can. It can give you freedom. It gives you choices when you want to retire earlier, or like the comment just made about changing jobs. But I have a client that I started working with in the late 90s. And when we first met, she had a goal. And her goal was to retire at age 50. And let me tell you, she had already put a lot of work into that goal. And so we ran the financial plans. We figured out together what she needed to save. We tested the scenario, and ultimately she was ready to retire at 50. I mean, she could. She didn't leave exactly at 50, but by the time she turned 50, she knew that all she needed to do was close the office door, lock it, and walk away. And she would have her freedom to enjoy all the things that she wanted to do, helping others, being involved in education, learning herself new things. And so that happened. I can't remember. I think she was 51 when she actually decided that she was ready to retire. So for some of the people on our audience that are still working, you're in your younger years, you're earning. When you think about retirement, one component of retirement is being able to invest in other things that you love, including the people that you love, that you may not be able to devote as much time and energy to today. And you can make that happen if you focus on it, plan for it, and put the right people around you to help you achieve those goals.
I think that was very well stated, Nancy, and I think we probably conclude on that. I think our one ask of you, and obviously you can see it here, we'd love to hear from you, right? Hopefully you've enjoyed the book this summer. Hopefully you've been maybe shared it with some friends or some other contacts. We would be happy to send a copy of the book to friends or colleagues of yours. Just send us a note and let us know where to send it. And then even bigger picture, obviously, we'd love to hear your feedback on this event. You know, did you get something out of it? Hopefully you felt like it was a good use of an hour of your time. And with that, I think we'll conclude here, and we appreciate everybody joining us this morning.
Thank you, everyone.